A woman in Ohio received a letter from the Social Security Administration demanding she pay back more than $17,000. She hadn't committed fraud. She hadn't hidden income. She hadn't done anything wrong. The SSA never explained what caused it. They just sent the bill. That case was investigated by a local news team in Ohio, and it is one of thousands like it that have surfaced in the past 2 years as the SSA's own rules shifted underneath people who were already collecting. There are 7 rules active right now in 2026 that can reduce or eliminate your Social Security or SSI payment, and most people collecting have no idea which ones apply to their situation. You don't need all 7 to apply. One is enough. And Rule 4 is the one your family may have already triggered on your behalf without either of you knowing it. Stay with me. Every rule in this video comes directly from SSA guidelines and federal reporting active in 2026. We're going through all 7. Before we get into it, this channel, USA Benefits Watch, exists specifically to track Social Security rule changes, Medicare updates, and federal benefit shifts the week they happen, in plain English with no filler. If you're on Social Security or SSI, or you're getting close, and you want to know about a rule change before it costs you money rather than after, hit subscribe and turn on the bell right now. The people who are subscribed find out in time. Let's keep going. Rule 1. The earnings test. Working before full retirement age. If you claimed Social Security before your full retirement age and you are still working a job with income, the SSA applies what is called the earnings test. This is not widely advertised, and it can wipe out a significant portion of your annual benefit. Here is how it works according to the SSA's 2026 fact sheet. If you will not reach full retirement age at any point this year, the SSA withholds $1 in benefits for every $2 you earn above $24,480 annually. That is the threshold for 2026. If you will reach full retirement age sometime during 2026, meaning your birthday hits that milestone this year, the threshold is higher. The SSA withholds $1 for every $3 you earn above $65,160, and only counts income earned before the month you actually reach full retirement age. Here is what that looks like in real numbers. A 64-year-old who claimed early and picks up a part-time job paying $50,000 a year is $25,520 over the lower limit. That triggers $12,760 in withheld benefits for the year. If that person is collecting $1,920 a month, that is more than half their annual benefit gone. Someone who turns full retirement age later this year and earns $70,000 in the months before their birthday is $4,840 over the higher threshold. That works out to roughly $1,600 withheld, a much smaller hit because the rules get more forgiving the closer you are to full retirement age. Now, here's the part the SSA does not advertise loudly enough. This money is not gone forever. Once you reach full retirement age, your monthly benefit gets recalculated to credit you for every month that was withheld. You get most of it back over time, just not on the schedule you were expecting. If this applies to you, do not wait for the SSA to sort it out on the back end. Call them at 1-800-772-1213 and report your estimated annual earnings before you start collecting. That way, they withhold gradually throughout the year, instead of hitting you with a surprise bill after the fact. Rule 2. Active overpayment notices and the 50% withholding rate. This is the rule that changed twice in the past 2 years, and the version currently active is not the one most people remember hearing about. In March 2024, the prior administration capped the default overpayment withholding rate at 10% of your monthly benefit. That came after years of reporting on people losing their entire Social Security checks to recover overpayments, many of which the SSA itself had caused. In March 2025, that policy was reversed. The SSA moved to withholding 100% of benefits until the full overpayment was repaid. That affected hundreds of thousands of people, according to Kaiser Family Foundation reporting at the time. After significant public backlash, the SSA landed on the rate that is active right now. 50% of your monthly retirement benefit withheld automatically, starting roughly 90 days after the notice is issued, unless you take action before that clock runs out. And here is the number that matters more than most people realize. The SSA's own Inspector General found that 73,000 overpayments in a single recent year were caused by the SSA's own calculation errors, not by anything the beneficiary did. That is what happened to the woman in Ohio. Kara Kendall received a $17,000 overpayment demand. The SSA never told her what caused it. She just got the bill. If you have ever received an overpayment notice, even one you thought was resolved years ago, you have three options, and most people only know about one of them. You can file Form SSA 561 to request reconsideration if you believe the overpayment determination itself was wrong. You can file Form SSA 634 to request a lower monthly repayment rate if the 50% withholding would create genuine financial hardship. Or you can file Form SSA 632BK to request a full waiver if the overpayment was not your fault and repaying it would cause hardship. Here is the critical detail. While any of those three requests is pending, the SSA is required to pause the withholding. That means filing fast matters more than filing perfectly. Get the form in. The clock stops while they review it. Rule 3. Spousal deeming on SSI. If you receive supplemental security income and you got married, moved in with a partner, or changed your living situation in the past year, your payment may have already been recalculated and not in your favor. Marriage triggers something the SSA calls spousal deeming. Part of your new spouse's income gets counted against your SSI eligibility, even though it is not your money and was never paid to you. According to the SSA's 2026 SSI guidelines, the maximum individual benefit this year is $994 a month. The maximum for a couple is $1,491. That means combining into a household can reduce total SSI income for a couple by nearly $500 a month compared to what two individuals would receive separately. If your spouse's countable monthly income after deductions exceeds roughly $497, the SSA begins treating your household as a couple for benefit purposes. That can shrink your payment significantly or eliminate it entirely, depending on the numbers. Here is the side of this rule that almost nobody mentions. Divorce can actually increase your SSI payment because your household income drops on paper the moment the status changes. The SSA also applies a combined $3,000 resource limit to married couples, even when only one spouse receives SSI. If your new spouse has a savings account, that balance gets folded into the calculation. Any change in marital status, marriage, divorce, separation, or a new person moving into your household must be reported to the SSA within 10 days after the end of the month it happened. Missing that window is how a living arrangement change becomes an overpayment notice 18 months later. You can report it through your My Social Security account at ssa.gov by calling 1-800-772-1213 or in person at your local field office. Do not wait for the SSA to find it on their end first. Rule 4. In-kind support and maintenance. This is the rule your family may have already triggered on your behalf without either of you knowing it exists. If you receive SSI and someone else, a family member, an adult child, a roommate, is helping cover any portion of your rent, utilities, or groceries, the SSA can reduce your monthly SSI payment by as much as $331.33 a month under what they officially call in-kind support and maintenance, or ISM. The amount of the reduction depends on how much support you are receiving and how it is documented. But the key word is any portion. A parent whose adult child pays half the rent. A senior whose daughter buys groceries every week. A retiree whose roommate covers utilities informally. All of these situations can trigger an ISM reduction, even when the help is offered out of love and the person receiving it had no idea the rule existed. There is one exception worth knowing. If everyone living in your household receives a public assistance benefit, SSI, TANF, or SNAP, the SSA generally does not apply ISM rules to support from other members of that household, on the assumption that everyone in that home is already relying on their own income. If you are not certain whether your living situation qualifies for that exception, do not guess. Call the SSA at 1-800-772-1213 or visit your local field office and ask directly. Guessing wrong and saying nothing is how a $331 monthly reduction goes unnoticed for 2 years and becomes a 5-figure overpayment demand. Rule 5. The resource limit. Frozen since 1989. If you receive SSI, the SSA limits how much you are allowed to have in countable resources. The current limit is $2,000 for an individual and $3,000 for a couple. That limit has not been adjusted since 1989. If it had simply kept pace with inflation, it would be above $5,000 today. It is not. It is exactly where it was nearly 4 decades ago. What this means in practice is that a modest savings cushion that felt completely safe 5 years ago may now be disqualifying, especially after a tax refund. A holiday gift from family, or a one-time payment hits your account at the wrong moment. The SSA evaluates your resources on the first day of every month. A large deposit that arrives in your account on January 3rd and is spent by January 31st can still disqualify you for January if the balance was over the limit on the first of that month. Certain things do not count toward this limit. Your primary home and one vehicle, for example. But a second savings account, an old life insurance policy with a combined face value over $1,500, or retirement accounts you are able to access, can all push someone over the line without warning. If you need to save beyond that limit without losing SSI eligibility, there is a legal tool for it. An ABLE account. As of 2026, anyone whose disability began before age 46 is eligible to open one. The first $100,000 held in an ABLE account is completely excluded from the SSI resource count. That is one of the only legitimate ways to build real savings while remaining eligible. Rule 6. The 10-day reporting window. Every time something changes in your life, your income, your address, your marital status, your living arrangement, the SSA requires you to report it within 10 days after the end of the month it happened in. Most people do not know that specific window exists, and missing it is one of the most common ways an overpayment notice gets generated in the first place, which brings you straight back to Rule 2 and the 50% withholding rate that is active right now. The good news is that reporting is faster than most people expect. You can do it through your online My Social Security account at ssa.gov by calling 1-800-772-1213 or in person at your local SSA field office. Getting ahead of a change before the SSA catches it on their end is almost always easier than untangling an overpayment after the fact. The SSA does not give credit for the fact that you were planning to report it eventually. Rule 7. The unreported address change. This one does not appear in most Social Security explainer videos, and it is responsible for more escalated overpayment cases than people realize. The SSA sends every notice, every determination letter, and every repayment demand to the address currently on file for your account. If that address is wrong, because you moved, because you are staying with family, because your mail goes somewhere different than your listed residence, those letters are going somewhere you are not. And the clock starts the moment the letter is mailed. Not the moment you read it, not the moment you call, the moment it leaves their office. That means a 30-day response window can be half over before you even know the notice exists. A waiver deadline can pass entirely. An overpayment that could have been disputed or reduced gets locked in simply because the letter never reached you. The fix takes under 2 minutes. Log in to your My Social Security account at ssa.gov. Go to your profile and verify that the address on file is current and correct. If you do not have an online account, call 1-800-772-1213 and ask a representative to confirm your address on file today. Do not assume it is right. Verify it. Summary: all 7 rules active right now in 2026. 7 rules. You only need 1 to apply. Rule 1. Working before full retirement age while collecting Social Security can trigger the earnings test and withhold more than half your annual benefit, depending on how much you earn. The money comes back eventually, but not on your schedule. Rule 2. An active overpayment notice, even one caused entirely by the SSA's own error, the way it happened to Kara Kendall in Ohio, means 50% of your monthly check is being withheld automatically under the current rate, unless you file one of 3 forms to stop it. Rule 3. Getting married or changing who you live with while on SSI triggers spousal deeming. Your spouse's income gets counted against your benefit, even though it was never yours. Report any marital or living change within 10 days after the end of the month it happened, through My Social Security, by phone, or in person. Rule 4. A family member or roommate helping with rent, utilities, or groceries can reduce your SSI payment by up to $331.33 a month under the ISM rules, even when the help was offered with good intentions and no one in the household knew the rule existed. Rule 5. The SSI resource limit has been frozen at $2,000 since 1989. A tax refund or a cash gift landing at the wrong time can temporarily disqualify you. An ABLE account is the one legal tool that can protect up to $100,000 from that count for anyone whose disability began before age 46. Rule 6. Missing the 10-day reporting window on any life change, income, address, marital status, living arrangement is how most overpayment notices get created in the first place. Report through My Social Security, by phone or in person. Do not wait. Rule 7. If your address on file with the SSA is wrong, the notices are going somewhere you are not, and the deadlines inside them are running, whether you see the letter or not. Log in to My Social Security today and verify your address is current. None of these are theoretical. These are the rules as they stand in 2026, and the SSA is not going to call you and walk you through which ones apply to your situation. Send this video to someone you know who is on Social Security or SSI right now. The odds are good that at least one of these 7 rules applies to them, and they have no idea. Subscribe to USA Benefits Watch so you find out about the next change before it costs you money. We track these rules the week they move. That is the only way to stay ahead of them.